How banks create money out of thin air. Most people grow up believing a very simple story about banks. You put your money into a bank account, the bank keeps it safe, and then it lends that money to someone else who needs it. That sounds reasonable. It sounds responsible. It sounds like the kind of explanation adults give kids because it feels clean, intuitive, and harmless. There's just one problem. That is not really how modern banking works. In fact, the truth is far stranger, far more powerful, and honestly a little disturbing, because in the modern financial system, banks do not just move money around, they create new money. Not metaphorically, not as a figure of speech. They literally create money by making loans. And once you understand that, you start seeing the economy differently. You start seeing why housing bubbles happen, why inflation feels so relentless, why governments panic when banks fail, and why almost everyone is living inside a financial machine they do not actually understand. So let's break this down clearly. We'll do it in 3 simple steps. First, we'll talk about the old story people believe about banks. Second, we'll talk about what banks actually do when they make loans. And third, we'll talk about why this matters to your life, your savings, your debt, and the entire economy. 1. The story most people believe about banks is simple and mostly wrong. The common belief is this: banks take deposits from savers and lend those deposits out to borrowers. In this story, if you deposit $1,000 into the bank now has $1,000 sitting there, ready to lend to someone who wants to buy a car, start a business, or get a mortgage. The bank is just a middleman. It is matching people who have money with people who need money. That description made a lot more sense in an older, simpler world. But modern banking does not work like a giant piggy bank. Your bank is not sitting there waiting for someone else's deposit before it can approve your loan. Here's the part that surprises people. When a bank approves a loan, it usually does not take pre-existing money out of some vault and hand it over. Instead, it creates a new deposit in your account. Let's say you walk into a bank and get approved for a $200,000 mortgage. Most people imagine the bank reaching into its pile of money and transferring $200,000 to you. But in reality, the bank typically types numbers into a computer and creates a brand new deposit in your name. On one side of the bank's balance sheet, it now has an asset, your loan, meaning your promise to pay it back over time. On the other side, it has a liability, the deposit it just created in your account. In plain English, the bank created new money by issuing debt. That sounds insane the first time you hear it. It sounds like cheating. It sounds like something that should only be allowed in a video game. But this is how modern money creation works in most developed economies. The majority of money in the economy is not printed by governments as paper cash. It is created electronically by commercial banks through lending. Now at this point, a lot of people say, wait a second, are you saying banks can just create infinite money? Not exactly. Banks are powerful, but they are not magic. They create money under constraints. They need borrowers who qualify. They need to meet capital requirements. They need enough liquidity to settle payments between banks. They need the confidence of regulators, markets, and depositors. So no, they cannot create unlimited money with no consequences. But yes, they can create new money in a way that is fundamentally different from how most people imagine. And this is where the real mind-bending part begins. 2. When banks make loans, they create deposits, and that expands the money supply. Let's use a simple example. Imagine there is a small town with one bank. You apply for a $10,000 business loan to open a coffee shop. The bank approves you. It does not go into the vault, count out $10,000 in cash, and say, good luck. Instead, it credits your checking account with $10,000. Yesterday, that money did not exist in your account. Today, it does. You can now spend it. You can pay a contractor, buy coffee machines, order beans, and hire staff. That new money enters the economy through your spending. Now the person you pay with that money deposits it into their bank account. Then they spend part of it. Then someone else receives it. The loan has created purchasing power, new spending power, new money circulating through the system. This is why bank lending matters so much. It is not just about moving existing money from point A to point B. It is about expanding the amount of money available in the economy. When banks are aggressively issuing mortgages, business loans, car loans, and credit card debt, the money supply can grow fast. When banks pull back and stop lending, the economy can suddenly feel starved of oxygen. Now, some of you may have heard of something called fractional reserve banking, which is often explained like this. If you deposit $100, the bank keeps $10 in reserve and lends out $90. And then that 90 gets deposited elsewhere, and that bank lends out 81, and so on. That story is not totally useless, but it is also outdated and oversimplified. In the real modern system, banks are not primarily lending out reserves in that neat classroom formula. They lend first when they believe the loan is profitable and allowed under regulations, and then they manage reserves and funding afterward. In other words, the old textbook version makes it sound like deposits create loans. In reality, loans often create deposits. That one sentence changes everything. Loans create deposits. Let's say that again, because this is the core of the entire video. Banks do not just wait for deposits so they can lend. Very often, they lend first, and in the process, they create the deposit itself. So where do central banks fit into all of this? This is where people often confuse two different things: base money and broad money. Base money is the money created by the central bank. That includes physical cash and bank reserves held at the central bank. Broad money is the money people actually use in everyday life, which includes the deposits in commercial bank accounts. When you check your bank balance on your phone, most of what you see is not central bank money. It is commercial bank money. It is a deposit created and maintained within the banking system. The central bank still matters enormously, of course. It sets interest rates. It influences the cost of borrowing. It provides reserves. It acts as lender of last resort when panic hits. But commercial banks are the ones doing most of the money creation you feel in real life. They are the engines creating deposits through loans. And this creates a strange but important reality. In our system, money is born as debt. A huge share of the money in circulation exists because somebody, somewhere, borrowed it into existence. That sentence should make you pause. Because it means debt is not just a feature of the system. In many ways, debt is the system. 3. Why this matters? Bubbles, inflation, bank runs, and your everyday life. Now let's talk about why any of this should matter to normal people. Because this is not just some weird accounting trick happening in an office tower. It shapes housing prices, business booms, financial crises, and the cost of living. First, bank-created money helps explain why asset bubbles happen so easily. Think about housing. When banks are eager to lend and interest rates are low, more people can suddenly borrow larger amounts of money. That sounds good at first. More buyers can enter the market. But if the number of houses does not rise nearly as fast as the amount of credit, then all that new money chases the same limited supply of homes. Prices rise. Then higher prices convince people that housing is a great investment, so more buyers rush in, often with more borrowed money. Banks see rising prices and feel more comfortable lending against homes that seem to go up forever. And just like that, you have a feedback loop. Credit creates higher prices, and higher prices justify more credit. It feels like wealth is being created. Sometimes it is, but often it is mostly leverage inflating asset values. Second, this system helps explain inflation. Not all inflation is caused by bank lending, of course. Supply shocks matter, energy prices matter, government spending matters, global trade matters. But when banks expand credit rapidly across the economy, they increase spending power. More money is now competing for goods, services, labor, land, and assets. If production does not keep up, prices rise. This is one reason why cheap credit can make everything feel more expensive over time. It is not just that people are earning more, it is that more money has been created through debt, and it is bidding for the same real-world stuff. Third, it explains why governments and central banks get so nervous when banks are in trouble. If a normal company fails, it is a problem. If a major bank fails, it threatens the money system itself. Remember, your bank deposit is not just some neutral storage box. It is part of the money supply. If confidence collapses and everyone rushes to withdraw money at once, the bank cannot simply hand everyone all their cash on demand. Because much of that money exists as loans on its balance sheet, not as stacks of bills in a basement. This is why bank runs are so dangerous. Banks transform short-term deposits into longer-term loans. Your money is available on demand, but the loans they made with that structure are paid back over years. That mismatch is manageable in normal times and terrifying in panic. This is also why central banks exist as lenders of last resort. When trust disappears, the whole machine starts shaking. Governments know that if the public loses faith in bank deposits, the financial system can unravel fast. That is why bank bailouts create so much anger. People see reckless institutions take huge risks, make enormous profits when times are good, and then get rescued when things go bad. It feels unfair because, frankly, it often is unfair. But from the government's point of view, letting the entire banking system implode can be even worse. Fourth, this system changes the way you should think about personal finance. Most people think money is something fixed, like water in a tank. But in reality, money in the modern economy expands and contracts with credit conditions. When banks are optimistic, money grows. When banks are fearful, money tightens. That affects mortgage rates, business hiring, stock prices, home values, and even whether your employer can access financing. So if you want to understand why the economy feels hot one year and dead the next, watch the credit cycle, watch lending, watch interest rates, watch defaults. The emotional mood of the economy often follows the expansion and contraction of bank-created money. And finally, this explains one of the strangest truths in finance. The system needs debt to keep functioning smoothly, but too much debt makes the system fragile. That is the paradox. If everyone stopped borrowing tomorrow, money creation would slow dramatically, spending would fall, businesses would suffer, and recession would hit. But if everyone keeps borrowing aggressively forever, bubbles form, defaults rise, and eventually something breaks. The system depends on a careful balance between credit expansion and credit discipline. Too little lending, and the economy stalls. Too much lending, and the economy blows itself up. This is why the financial world constantly swings between euphoria and fear. In the boom, banks want to lend, borrowers want to borrow, investors want more exposure, and everyone acts like risk has been solved. In the crash, everyone suddenly remembers that loans have to be repaid, collateral can fall in value, and confidence can vanish overnight. The money machine goes into reverse. So if banks create money, what destroys money? Loan repayment does. When you pay back the principal on a loan, that money is effectively extinguished from the banking system balance sheet. The deposit created by the original loan had expanded the money supply. Repaying the principal contracts it. Interest is a little different because that becomes income to the bank, but the principal repayment is the key point. This means money is constantly being created and destroyed inside the system as new loans are made and old ones are repaid or written off. The money supply is not a static pile. It is a living, breathing process. And yes, this raises an uncomfortable question. If money is created as debt and loans require interest, where does the extra money come from to pay the interest? The answer is from the ongoing circulation of money in the economy, including new lending, wages, business revenues, and spending flows. The system does not require every dollar of interest to be pre-created in the exact same loan event. But it does mean the economy is heavily dependent on continuous activity, continuous income, and usually continuous credit expansion somewhere in the system. That is one reason modern economies are so obsessed with growth. Growth is not just a political slogan. It is a stabilizer for a debt-based money system. Now, to be fair, this system is not pure evil. Bank-created money has real benefits. It allows businesses to invest before they have years of savings. It allows families to buy homes. It helps finance innovation, infrastructure, and expansion. A world in which every loan required someone else to literally save the exact amount first would be slower, more rigid, and probably less dynamic. Credit can be productive. It can help build real prosperity. The problem is not that banks create money. The problem is what that money gets used for, who gets access to it, how much risk builds up, and who gets rescued when the game goes wrong. Because if banks mostly create money to fuel productive investment, you can get more businesses, more jobs, more output, and more real economic growth. But if banks mostly create money to inflate existing assets like housing, stocks, and speculation, you get a very different society. You get one where asset owners get richer, young people get priced out, and inequality worsens. Same money machine, very different outcomes. So the next time you hear someone casually say, banks just lend out deposits, you'll know the truth is far more interesting. Modern banks are not just warehouses for money. They are manufacturers of money. They create purchasing power through lending, under rules, constraints, and with massive consequences for the rest of society. Your mortgage, your credit card, your business loan, your savings account, your rent, your inflation, your recession, all of it sits downstream from this hidden mechanism. And maybe that is the strangest part of all. One of the most powerful systems in modern life is mostly invisible. People spend years working for money, stressing about money, borrowing money, investing money, and voting over money without ever being told how most of it is actually created. We're taught how to balance a checkbook, if we are lucky. We are taught to budget, save, and maybe invest in an index fund. But we are rarely taught that commercial banks create the majority of money in circulation when they make loans. Once you understand that, the economy stops looking like a natural force, like the weather. It starts looking like what it really is: a man-made system, designed, regulated, incentivized, and sometimes distorted by institutions with enormous power. Banks are not gods. They are not printing infinite wealth from nowhere with no limits, but they are doing something close enough that every citizen should understand it. So here's the simple takeaway. Number 1, banks do not merely lend out existing money. When they issue loans, they often create new deposits. Number 2, this process expands the money supply and shapes everything from housing prices to inflation. And number 3, because our money system is deeply tied to debt, the entire economy becomes dependent on the rise and fall of credit. That's the game. That's the machine. And once you see it, you cannot unsee it. If you enjoyed this breakdown, subscribe for more videos that explain how the financial system really works, and drop a comment with the next topic you want unpacked. Because once you understand the hidden rules of money, you stop being confused by the headlines and you start seeing the system for what it really is.